Somewhere in the last few years, a $1,000 monthly car payment stopped sounding extreme and started sounding ordinary. You probably didn't consciously decide that it was reasonable, but repeated exposure slowly normalized the number in your mind. When you hear friends mention their payment or see online posts about new vehicles, the figure blends into the background of adult life. It becomes categorized as one of those unavoidable expenses like rent, groceries, utilities, or health insurance premiums. But unlike rent or food, a car payment is not purely survival, even though it often feels that way. Transportation is necessary in most of America, especially when public transit options are limited or inefficient. Yet the type of transportation you choose exists on a wide financial spectrum that most people rarely examine carefully. The jump from reliable transportation to aspirational transportation often happens quietly through financing structures rather than deliberate reflection. You are not usually deciding whether to spend $50,000 in one painful moment of clarity. Instead, you are deciding whether you can handle $1,000 this month without disrupting your immediate lifestyle. That framing changes everything because your brain evaluates short-term affordability very differently from long-term total cost. $1,000 feels like a budgeting decision, not a multi-year income commitment that will follow you through economic uncertainty. If you pay $1,000 per month, that equals $12,000 per year, leaving your account after taxes have already been withheld. To bring home that $12,000, you likely needed to earn closer to $16,000 or more in gross income, depending on your tax bracket and state. Now, stretch that across a standard 5-year loan term, and you are looking at $60,000 in after-tax cash flow devoted entirely to the payment itself. Once you include insurance that might easily run $250 per month, the annual outflow climbs by another $3,000. Add fuel, maintenance, registration, and unexpected repairs, and the true yearly cost can move towards $16,000 or even higher. Over 5 years, that approaches or exceeds $80,000 in total cash flow dedicated to a depreciating asset. What makes this powerful is not just the number itself, but how invisible the accumulation feels in real time. You never feel $80,000 leaving your life all at once in a dramatic, painful transaction. You feel manageable slices, neatly packaged into monthly autopay withdrawals that blend into your banking routine. The system is structured to emphasize comfort in the present while minimizing reflection about cumulative impact. Dealership conversations rarely begin with total repayment projections, including interest and insurance, over several years. Instead, the focus almost always centers around what payment fits into your current monthly budget without discomfort. Extending a loan from 60 months to 84 months can reduce the visible payment while increasing total cost substantially. Lowering the monthly number creates emotional relief, even though the financial obligation becomes heavier and longer lasting. This is not accidental design. It aligns perfectly with how human psychology discounts future consequences. You naturally weigh present convenience more heavily than distant financial flexibility that feels abstract and undefined. Meanwhile, vehicles depreciate rapidly, often losing significant value within the first year of ownership. That depreciation does not pause simply because your loan term was extended for affordability. As a result, many buyers find themselves owing more than the vehicle is worth for a meaningful portion of the loan. Being underwater financially creates subtle stress, even if you rarely articulate it directly. It limits your ability to sell, refinance, or pivot without bringing additional cash into the equation. This is where the emotional paradox begins to take shape in your everyday life. You might be earning more than you did 3 or 5 years ago with promotions and higher salary figures. On paper, your financial trajectory appears upward, and your lifestyle visually reflects that growth. Yet, despite the higher income, your monthly margin feels surprisingly thin and fragile. A large fixed car payment quietly absorbs a meaningful percentage of your take-home pay before you even see it. If you bring home $5,000 per month and $1,300 goes toward total vehicle costs, more than a quarter of your income is already committed. That commitment reduces your flexibility long before rent, student loans, food, utilities, and insurance are considered. Flexibility is the space where investing, saving, and strategic decisions are made, calmly rather than reactively. Without that space, even small unexpected expenses can trigger outsized stress responses and financial scrambling. Inflation compounds this tension because rising prices in other categories squeeze the remaining margin further. Your car payment does not adjust downward when groceries become more expensive or insurance premiums increase. It remains fixed, contractual, and non-negotiable once the paperwork is signed. This rigidity forces adjustments elsewhere, often in areas that would have strengthened your long-term financial position. Maybe retirement contributions are reduced temporarily to preserve cash flow for immediate obligations. Maybe high-interest credit card balances linger longer than intended because monthly cash feels constrained. Maybe opportunities that require risk, like career changes or relocations, feel too dangerous under heavy fixed expenses. Each of these adjustments seems small and rational in isolation, but together they reshape your trajectory. The illusion is not that you can't afford the car in a narrow technical sense. The illusion is that affordability is defined only by surviving the monthly payment without overdrafting. True affordability considers opportunity cost, flexibility, and resilience against economic volatility. Imagine instead committing to a $400 monthly vehicle expense rather than $1,000. The $600 difference each month equals $7,200 per year available for investing or debt reduction. Over 5 years, that becomes $36,000 in direct contributions without even accounting for potential market growth. If invested consistently at a modest average return, that difference can compound into 6 figures over decades. Compounding works quietly, just like car payments do, but in the opposite direction of wealth erosion. One drains future options gradually, while the other expands them with equal subtlety. Neither feels dramatic in any single month, which is precisely why they are so powerful over time. Culturally, however, the visible symbol of success tends to be the newer vehicle rather than the growing brokerage account. You receive immediate social validation from a car that signals progress and stability to others. You do not receive similar external recognition for choosing a lower payment and investing the difference. That asymmetry in social reward reinforces decisions that prioritize appearance over structural financial strength. This doesn't mean enjoying a nice vehicle is inherently irresponsible or misguided. It means understanding that every large recurring expense represents a long-term contract with your future self. When too much of your income is pre-allocated before you even receive it, intentional choice narrows. Life begins to feel like a series of obligations rather than a landscape of options. Earning more income can temporarily mask the pressure, but fixed costs tend to expand alongside earnings. The car payment becomes part of that upgrade cycle, reinforcing the idea that higher income justifies higher commitments. Yet income can fluctuate, industries can shift, and economic conditions can change faster than long-term loans expire. Resilience in uncertain environments comes from lower fixed costs and higher liquidity, not from impressive monthly payments. When your expenses are leaner, unexpected events are inconveniences rather than crises that threaten stability. When your margin is wider, you can negotiate, pivot, or pause without fear dominating the decision-making process. The deeper psychological shift occurs when you redefine success away from visible consumption towards structural independence. Structural independence means fewer obligations competing for your future time and energy. It means your paycheck is not already spoken for by agreements signed years earlier under different assumptions. The $1,000 car payment illusion thrives because it feels incremental, ordinary, and socially reinforced. It rarely feels reckless in the moment, especially when lenders approve you and peers validate the purchase. But lenders evaluate risk differently than you evaluate freedom. They care about repayment probability, not about how constrained your life might feel under sustained obligations. Approval is not the same as alignment with your long-term goals or values. When you zoom out and analyze total cash flow across 5, 7, or even 10 years, clarity sharpens. You begin to see how much of your productive effort is being directed toward maintaining a depreciating asset. That realization is not meant to induce guilt, but to restore agency over future decisions. Awareness allows you to evaluate trade-offs explicitly rather than drifting into them through normalized expectations. A vehicle can be transportation, enjoyment, and even personal expression without consuming disproportionate financial bandwidth. The key is recognizing that monthly framing often disguises lifetime impact in subtle but profound ways. When you choose commitments that preserve margin, you buy more than financial stability. You buy time, optionality, and the quiet confidence that your income serves your priorities rather than predetermined contracts. In an era defined by rising costs and economic unpredictability, that flexibility may be the most valuable asset you can own. Thanks for watching. Support Playing the Money Game. Like, comment, and subscribe. See you in the next video.